Hello, everybody. Brian here again, once again on Facebook, YouTube, hopefully eventually. I'm just experimenting with some stuff here. I'm going to put myself on camera. Hi, how are you? 5 o'clock shadow going, I know, but we are just tinkering around with some stuff. Now I'm going to set up my desktop. Okay, let's jump over to that article. Okay, so I'm finding it quite interesting that this website here from Medium, I'm assuming, towards data science has got some really cool stuff, and very cool, I might add. But just seeing myself on Facebook here on another monitor. Anyways, this is a really good article. I do get people asking me about simple ways to develop algorithm systems. You know, I can't compete against free resources. This is one of them. Obviously, it's built around machine learning. Machine learning is a lot more complicated than doing anything else that I know of. I'm not yet at that point to say I can even start with machine learning. But I'm going to be honest, I'm very intrigued by the popularity of it. Does it work? We don't know. I just put up another live video before that and showcasing genetic algorithms, which I'm really interested in. And one way to apply it is definitely on the ranking on the cryptocurrency pairs that I choose. So once again, we have the ability to basically go through this with an algorithm machine learning framework in Python, of course. What else? And this time for energy markets, because we know that right now the oil markets are up and down, and up and down they go. Anyways, I'm not going to go too much into the article here. This is some industrial stuff, I'm sure. You know, blah, 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 blah. Okay, so here we go. They want to do some kind of auctioning of using machine learning in the energy markets, where we have, I am going to assume here, price of natural gas to per calorific unit drops below the price of Brent oil. So some correlation there. Power producers should switch over to the less carbon intense fuel, lowering the demand for carbon allowance, blah, 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 blah. So we have here is, I guess we have some form of correlation between ABS and a percentage in differential. If you followed me on my future stuff, wow, way back, I'll be doing that again. Differential is really good because especially interest rate differential on a central bank where you have interest rates between different countries going up, where an interest rate, money will pile into that. Those set of fixed income bonds, because the interest rate, people pile in, price can go up. And, you know, that's the theory. And especially with Trump now becoming more of an isolating the US and fewer pacts between countries, there's opportunity there. So the correlation is very important. So there's all these different factors here. Actually, sine, qua, non, I don't know. Dispensable assumption for analytic modeling. Obvious settings too complex for any approach line to model market based on generic beliefs. This is the tough part about blah 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 modeling in the world of finance, because there's so many different ways to do it and different asset classes. So here's the steps: data, model, train, trading policy, backtest, live trading. So we get our data, APIs, Alpha Vantage or Quandl. They have a great, Quandl has a great connection into Python. You just got to pay, ain't cheap. But they're getting institutional now. Blah, 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 blah. You might want to include rolling averages of various lengths to provide your model and historical context, especially if your learning algorithm does not exclusively like recurrent neural networks or LTSMs. I put out an email. You should be on my email list. I put out an email blast on all the different methodologies of machine learning. This one, LSNTM, came out #1. Now again, you got a back test, blah 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 blah. This one did okay. And then of course we have all our favorite indicators, technical analysis, RSI, ADX, Bollinger. We apply those on a moving average, some quantity versus price or trading volume. And it is very simplistic. You want to keep it simplistic because the more complicated it is, the more processing time it takes, and da da da. Model reflect trading behavior of majority of market participants. Usually what I find, if you're in a retail broker, you're only dealt with the participants in the broker network, as I like to call it. Can be a limiting factor. Yeah, that's true. Hard-coded, unique purpose algorithms, market making. That's the big one. If you're not with an ECM in the world of Forex, you know, like Duca's copy, and you flip over to an Oanda, you got market making to contend with. So interesting stuff, I know. Okay. Then there's, of course, arbitrage. You had one guy asking about that yesterday. And of course, we have the different machine learning modeling platforms or whatnot. You can use TensorFlow, which seems the industry is using because it's open source and it's from Google. Clean data, charted, blah, 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 blah. So we have supervised model training. Test set should follow the same distribution. Making sure we follow the same market regimes, extended periods where a specific combination of commodities dominate the price dynamics of your target instrument. Oil, I'm assuming London, where it's traded at that time, where it's active and it's open. Might be worthwhile to first have a clustering algorithm or unsupervised learning algorithm defining correlation in the data and evaluate the model performance on data in the validation and test site belonging to the same cluster. So here's the, now again, this is out of my league in terms of what do we call concepts here. I gotta learn that. In this project, clustering increased predictive performance by 8%. So context, single number evaluation metric. So in the context, suitable measure is profit loss, P&L, price up and down, weight. So that's your weight, classification, precision, and the actual size of the swing, the relevance. Interesting. That's why I like doing these. You learn actual size of the swing, relevance. To me, that's magnitude of the swing, I guess. Depends on your metrics. You may wonder, consider for your trading policy. Now, we've already talked about in a previous video I did the genetic algorithms on the policy, and this is, I guess, talking about the machine learning world. We have a model bias, trading value. If error on the trading set, when model bias is high, you may need to allow for more model parameters, more layers, neurons in a deep learning model. Ooh. Model poorly generalizes, overfitting to the training set. That's performance on difference on validation. Training set model variance is high. You may need to add more data on the training set. This is where it gets complicated because when I started throwing algorithm out, or yeah, sorry, I just got to make sure my battery stays on here. Hang on, my of the laptop here. Sorry. Just give me a second here. Let me just make sure I have something working. Hooray, my battery's okay, good. All right, so this is the complicated part because there's so many factors to deal with when it comes to these modeling. I like just using indicators, and if it works, set a target. And if the price meets that target, you get in. So there's so many different factors here. So here we have what I felt was too many false positives, false negatives, correct forecasts. Price swing on the forecast confidence. So we have to have our target performance, which is the same as saying basically saying the same thing as accuracy. When you look at the harmonic patterns that I looked at, they were roughly 40 to 60% accuracy. Obviously, they're not going to be accurate. That's why I got to have other indicators running in parallel. On top of the reason with a candlestick reversal patterns, I like to only work with maybe 60, some of them are 80% accuracy. And there's that the pattern site.com, and that basically also focused on the better performing. But you go through that site, and I've got various videos on my YouTube channel that talk about that. Let's see here. Is closed environment affecting? So then here we get in that, again, the trading policy. Let me just see how long this article is, quite a bit. So this is just not going to get into actual coding, but it's an overview. And again, that framework. So just so you know that. You define your trading policy, rules, concrete trading, implications on model output, threshold for model confidence of a given prediction, position you do place on your market, what position size, for how long. Policy usually comes with free parameters. Need to be optimized next step. Context of supervised learning discussed here. This is fairly manual process. So then again, we get into optimization and backtesting. So this is the numbers and the results. Prediction model given on a holdout set of historical market data using step 2 model training, and can become the validation set for tuning the parameters of the policy. Again, now we talked about the genetic algorithms previously, allow you to explore the policy space starting from a generation of 100 randomly chosen policy parameters. In my case, in the previous example, in the previous video, there's actual code there for in Python. In my case, I've got, let's say on Binance, 300 different plus cryptocurrency pairs. I scan them, run them, get some different results. And then there's that massive spreadsheet that I've run. I can pump out some genetic algorithm results from this. So here we get, for example, the 80 worst performers, 20 best survivors, and then we're able to produce different offspring from that. Or you can employ grid search in multi-dimensional parameter space, starting from a plausible values from the parameters of the policy, what is best performing you can achieve by parameter values one by one. Ooh, that sounds complicated. Your performance metric here wants you to optimize your trading, e.g. P&L, like return on investment, Sharpe ratio, turn per volatility, value at risk, the beta, so on. I think that would be a little more complicated, but it'd be interesting to do a study on that. Good measure to prevent overfitting and parameters of validation is cross-validation with a walk-forward test. Robert Pardo, do you hear me? Verify the robustness of your approach. Optimize policy parameters. Test them forward following validation. Shift the validation toward include data, repeat, and basic your best gauge. Better gauge for future than the more distant the past. If that makes any sense. Let's see what else. Wow, that's quite a bit. Oh no, we got 2 more paragraphs. So what we got to do is freeze all system parameters and test in real time. That's easy. With Binance, if you're on Binance or any broker really, or exchange. Placing your orders according to the outputs of your trading algorithms. Important step is called paper trading, and it's crucial limits for the validity of your approach. I'm entering that into now with my simplistic technical analysis stuff. You'll notice here your historical data and used values are not really available at the given time. That's true. When calculating moving averages. If your strategy looks promising, congratulations, time to go live. Well, I might start by placing your orders manually. Do not underestimate both the administrative and historical it takes to integrate your strategy with your API of the exchange. Yes, we know that. But again, that's why I like the world of crypto and being on being on a better exchange like Binance. So how much more do we have to read here? So there is shortcomings. Derivative contracts is pretty institutional. Historical data report the open loss, which shows in time interval settle average time of contracts and all deals realized in the interval. Now, okay, let me say right here. In world of crypto, you could be on BitMEX, which does market making. So that's a derivative kind of exchange. So this could apply here. Settle contracts and all real in the interval, but there's a likely price where you can clear your buy or sell. Be the price for which you clear your dynamics of your order book, which have different volumes at various bid-ask levels. Your model prediction from step 2 do refer to theoretical price, not the price you will place bets on. And that's pretty well what you're doing. More detailed modeling approach you would need to take into account structural and dynamics of the order book. Okay, note that. Developing policy, machine learning-based modeling, but manual process guided by intuition, experience, or just simple heuristics. This is where I always say being a trader versus a programmer or mathematician always overrules the performance because of that experience. Example, you place a buy order going long when the model predicts a price increase, but how many contracts do you buy? This again is where I guess they call it policy, where what's your position sizing and what confidence threshold do you use? How long do you hold your positions in face of the adverse market conditions? Okay, in my scenario, portfolio optimization, if you go on my YouTube channel for that, and what confidence threshold do you use? I don't know, momentum. There's other ones as well, what I use. And how long should you hold your position in the face of adverse market conditions? That's why I use a simple indicator like ATR. Yeah. Feedback comes late, undergo steps 1, 2, 3. Model prediction optimized for independent, even if model policy usually interact closely. Squarespace policy and efficient numerical optimization, not with predictive machine learning model. Framework of the reinforcement integrates steps 2 and 3. Modeling trade as an interaction, optimized by its order while early stage, blah, 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 blah. Don't know if there's any coding here. I don't think there's. It's just a general concept of a general idea of a framework, but this is quite interesting. Hopefully have any feedback or whatnot, just comment away in the Facebooks or the YouTube if I can get it on YouTube or wherever else. And we shall talk to you later. Over and out.